So the new Income Tax Act of 2025 is here, and, professionals everywhere are getting up to speed with all the new provisions. Today, we're going to zero in on one that's super important for any trade or professional association, Section 50. It tackles a very specific, and I mean very common, financial question. Let's kick things off with a classic scenario. Picture this. A local chamber of commerce spends more money on events and advocacy for its members than it brings in from membership fees, so they're in the red. The big question is, can they claim that shortfall as a deductible loss for tax purposes? It's a fantastic question, and thankfully, Section 50 gives us a straight answer. All right, here's our game plan for today. We'll start with the core problem these associations face, introduce Section 50 as the solution, and then break down all the conditions. We'll walk through a real-world example, talk about compliance and what not to do, and then wrap it all up with the key takeaways. Okay, first things first. To really get why Section 50 is so important, we need to understand the problem it was created to solve. And it all boils down to the unique way these kinds of associations work. You see, most of these groups run on what's called the principle of mutuality. It's a simple idea. A group can't really make a profit from itself, right? Members are just pooling their money for a common good. But that simple idea gets complicated when the opposite happens. What if the group spends more than it collects? This deficit isn't a normal business loss, and that creates a real tax headache. And that headache is exactly what Section 50 of the Income Tax Act 2025 is designed to cure. It steps in and provides a clear, specific rule for this exact situation. It recognizes that, hey, if you're serving your members' common interests, sometimes you're going to have a shortfall, and that should be recognized by the tax system. The actual text of the law is pretty straightforward. I won't read it word for word, but the essence is this. If the money an association gets from its members is less than what it spends on their collective behalf, then that exact difference, that shortfall, is allowed as a deduction. It's a really powerful rule because it turns what would be a financial problem into a legitimate tax deduction.
Now, here's a really crucial detail. The Act is very particular about what counts as receipts from members for this calculation. It includes all the general stuff, subscriptions, annual dues, things like that. But, and this is a big but, it explicitly excludes any money they get for providing a specific service. So if they charge for a seminar or sell a special report, that income is treated separately. It doesn't get mixed into this deficit calculation.
Of course, this is tax law, so this amazing benefit isn't for everyone. There are some very specific conditions you have to meet to be eligible. So let's break down who actually qualifies. The law uses this special term, specified association, and to be one, an association has to pass two key tests. First, it can't distribute its income to its members. That makes sense, right? It goes back to that mutuality principle. And second, it can't be one of the professional bodies that are specifically excluded by law. So who's on that exclusion list? Well, Schedule 3 of the Act points to the big regulatory bodies. We're talking about associations for law, medicine, accountancy, and so on. These institutions have their own set of rules and are carved out of the Section 50 benefit. So if you're advising one of them, this section just won't apply. Now, for those of you who've been in the tax world for a while, this idea might sound pretty familiar. And you'd be right. Section 50 isn't some brand new concept. It's basically the new and improved version of Section 44A from the old 1961 Act. The main principle is the same, which is great because it provides some much-needed continuity as we all transition to the new law. Okay, enough of the legal theory. Let's make this real. The best way to see how this all works is to just run through a practical example with some actual numbers. So let's meet the ABC Textile Association. As you can see, they collected 8 lakh rupees in member subscriptions, but their common expenses, things like lobbying for the industry and general research, came out to 10 lakh rupees. Simple math tells us that creates a deficit of 2 lakh rupees. Now, separately, they also earned 3 lakh rupees from a paid seminar and another 1 lakh in interest income. So what's the magic number? What's the deductible amount under Section 50? It's that deficit of 2 lakh rupees, plain and simple. This amount can then be used to offset the association's other taxable income, which, in our example, is that 4 lakh from the seminar and interest. This directly reduces their tax bill. It's a straightforward calculation, but wow, it can have a huge impact. Understanding the math is one thing, but making sure you're compliant is the next big hurdle. You really don't want to get this wrong, because that could mean penalties. So let's talk about how to do it right. Here's a simple little checklist to follow. First, just verify your status.
Are you actually a specified association? Second, and this is huge, you have to segregate your income. Your accounting books must have a crystal clear line between general fees and money from specific services. Third, be prepared to prove that your expenses were really for the common good. And finally, and you know this, document everything. Board meeting minutes, member emails, you name it, keep it.
And on the flip side, here are the common traps to avoid. The number one mistake, by far, is mixing in fees from specific services when calculating the deficit. Another big no-no is trying to claim capital expenditure as a common expense. And of course, sloppy record keeping is a huge red flag for any tax officer. And finally, if an association distributes its income to members, it's automatically disqualified. Game over.
All right, we've covered a ton of information, so let's take a breath and just quickly recap the absolute most important points you need to remember about Section 50. Okay, here's the bottom line. First, Section 50 is a specific tax deduction for the shortfall between member fees and common expenses. Second, it's only for specified associations, so remember those exclusions like the Bar Council. Third, always, always, always exclude income from specific services from your deficit math. Fourth, remember this isn't totally new. It's a carryover from Section 44A. And finally, clean books and good documentation are absolutely non-negotiable.
So I'll leave you with a practical question to chew on. Now that you've got the lay of the land, take a look at your clients, those trade bodies, chambers of commerce, and industry associations you work with. Can you now confidently figure out if they're eligible for this deduction? Because this isn't just some abstract rule, it can make a real financial difference for them.
And that's a wrap on Section 50. Thank you so much for joining me for this explainer. If you found it helpful, do me a favor and hit that like button, subscribe for more breakdowns of the new Tax Act, and please share this with anyone in your network who might need it. And just the standard reminder, this video is for educational purposes only. It is not professional advice. Tax laws are always changing, so please be sure to consult with your own professional advisor before taking any action.